Hello, everybody, and welcome to the monthly market memo for the month of September 2024. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in this month's video, short video, we wanted to dissect some of the major news headlines that were driving our markets, talk about the returns that were given for the month of September, and then fast forward to the month of October and further out than that, and talk about some of the things we're watching here at Retire Path Advisors. So without further ado, let's go ahead and jump into a little bit about the review. So the month of September really started and ended in similar fashion to the month of August. If you remember, the month of August started off down, and then we ended up higher for the month. September, same thing. We started off down for the first week, down about 5% or so, depending on what stock market index you're looking at. And then fast forward to the end of the month, and we are up over 2% in the S&P 500, up over 1% in bonds, and up over 2.5% in international stocks. Now, what were some of the major headlines driving that ups and downs? At the beginning of the month, we always get the jobs report number, and the jobs creation number has been causing volatility. The number of jobs created, the market was a little worried about that, a little bit worried about the unemployment rate. But after that was all settled, we moved higher. Also, within that time period, we saw earnings announcements for some of our mega cap stocks in the index, like NVIDIA. NVIDIA, again, good numbers, but the growth over expectations wasn't quite there and led to some negative declines. Again, bounced back, though, towards the end of the month. So a very similar month to August, started off slow, ended up higher. And if you really just looked at your balance once a month at the end, you would see higher returns there and didn't notice any volatility. However, we still are focused on inflation. It's going to be a big talking point in the upcoming election. It's obviously something we see at the gas pumps, at the grocery stores, but we are nearing 2.5% year over year inflation. That's much better than a couple years ago, 2022, where inflation was right around 9% year over year. So now, of course, you can't, this isn't deflation. We're not seeing lower prices than we did a few years ago, but that pace of increases is a lot more comforting to the Federal Reserve to look at cutting rates. And cutting rates is exactly what they did. That was another major headline, which we talked about in last month's video, is the impact of rate cuts and what should we expect for rate cuts. So the Federal Reserve cut interest rates on short-term lending by exactly 0.5%, or 50 basis points, as we call it. And that impacts, of course, your CDs. It impacts mortgages, it impacts credit card rates, and it really impacts everything. A couple of reasons why they cut rates. Again, inflation is near target. Real rates did not need to be as high as where they were. And also the unemployment rate and jobs creation is picking up, and jobs creation is slowing down. So the Federal Reserve wants to get ahead of that and to try to avoid any sort of more softness in the jobs market by cutting rates and loosening lending standards there. And then finally, what to watch for next month, and I'm going to get into a few charts here to visualize this. We do expect election rhetoric is going to pick up even more than what you've seen in your local media. Of course, we feel it is very important to take part and have your vote counted. It is really less clear on how this is all going to impact policy, right? Who becomes in office? What's the split of Congress? What can even get through at the end of the day? And at the end of the day, how does that all affect our financial markets and stocks and bonds? One thing we feel that is likely is volatility, the daily swings or weekly swings you see, ups and downs in the stock and bond market, will be present. And we have some numbers to show that here. So again, just something to be aware of, be anticipatory for, that the increase in the volatility will likely be there, as it typically always is as we near the election. This chart just shows the VIX, which basically know that if it's a higher number, that's higher volatility in the S&P 500. What you notice there is the level of change. The numbers don't really matter so much, it's just the level. Now, October, you see the numbers move a lot higher as we near the election, right? We're not quite sure who wins. After it is decided who wins, we see volatility drop. And then December and January and further out, really much more normalized level of volatility. So it is something to be aware of, and it's something we seek to manage your risk here at Retire Path. Now, one thing that is typically always question I get is, should we just step out of the market for a little bit and sit on the sidelines and try to avoid that volatility? Now, of course, your personal goals are always different than anybody else's, so that may be the right case. But for us as longer term investors, especially in your growth assets, we want to remain invested. We want to remain invested in a prudent, well-diversified portfolio because over time, as you see on the left-hand side of this chart, the S&P 500 over the last 20 years or so is up about 10%. Now, let's fast forward and say you missed out on some of the 10 best days, right? You went to cash and missed out on some of those. You hampered your returns and cut them in half, cut them in almost in half, right? They go down to 5.5% if you miss the 10 best days. Now, the best days and the worst days typically cluster, they're around each other. So there's a good chance that if you step out of the market during those volatile times, you may likely miss out on those best days. So again, it's always better to try to remain invested for those longer term time periods and just know that we are seeking to manage your risk in a lot of different ways. And that's what I wanted to wrap up this call with, is talk about a lot of different ways we're managing your risk here at Retire Path Advisors. Of course, if you're taking income, cash is still king, I guess, as you call it. Cash does return above inflation. It is a viable investment right now, and that's really good for retirees that need that income, that monthly income. If you're taking income off your assets that we advise on, it's likely you have several months or maybe even a couple years in cash that can weather any amount of short-term volatility, right? Again, this election, it will come, it will go, and we'll move on to the next 4 years, and we'll talk about it again. It is short-term volatility. And just know that you have that amount in ultra-short bonds and or cash to weather that volatility. Now, kind of in more of our middle bucket, we talk about core bonds a lot. Now, bonds are back. A couple of years ago, bonds didn't yield much. They yielded right around 1.5%, and that's roughly what you can expect for your return on bonds over the next 5 or 10 years. Fast forward to today, after the Federal Reserve really increased interest rates, and we're up over 4%. So that is a material difference in coupon rates. 4%, much higher than 1%, which means that we get much more yield from our bonds that we hold. And also, we've started to see the negative correlations come back, which means lately, if we've seen stocks decline as maybe anticipation of a little bit of a growth weakness in GDP or people rising unemployment, we've seen the bond yields fall, which actually means prices rise, right? So stocks down, bonds have been up. Maybe it doesn't happen every single day, but lately, over the past weeks and months, we've seen that relationship there, which is a great risk management technique to see come back into fold. Now, bonds aren't the only way to manage risk. We also look at, again, more in that middle term bucket for you, more of options, hedging strategies. Now, this gets, maybe a little in the weeds, but just know that we do our due diligence here and look at funds that invest in protective puts or covered call writing. And both of these strategies reduce the volatility of stocks without the need for bonds. It's another risk management tool in our toolbox that we use for you. Now, for some of those longer term investors, just know that we do diversify the equities, right? Which are the stocks. You will always have allocations, of course, in large caps, mid caps, small caps, and some even to international stocks. This really helps avoid and cover some of those idiosyncratic risks that you see in one single stock. Maybe it's NVIDIA or Apple or Google. And always know that we're going to be diversified there. The growth bucket is that longer term bucket to help capture the market growth, outpace long-term inflation, and facilitate withdrawals when they come. And then finally, if you're more in that accumulation phase, you're a younger investor, you're an accumulator, maybe you don't have to take income yet, you don't need or want to take income yet off these investments. Really, time is your best diversifier. You have time to wait out through this volatility. You have time to remain invested and really let the magic of compounding work in your benefit. Really just stay invested for the long term, and markets do heal themselves over time. So big picture, expect volatility for the election to come up. Sitting out of some of those stock market gains can really hurt you. And just know that Retire Path Advisors has many ways to manage your risk over time. That's it for this month's video. Again, thank you for your trust. We approach the management of your complete financial landscape very seriously. As a trusted steward, advocate, and confidant, we are truly committed to you. You can find us on our website where we have all the past recordings of these videos and a lot of great blogs around the election and the Federal Reserve cuts and everything else. You can find it on our website. Email us, call us, reach out to your advisor with any questions you may have. Of course, I'm always available as a resource as well. Thank you again, and have a great fall. Thank you.